There, Mike Aronstein of Market Field Asset Management says analysts continue to underestimate the strength of the U.S. economic recovery. Mike is here with us now, and Mike, it was quite a feat. You were stuck on the Bruckner Expressway, snarled in traffic. You make like Superman to get here in time to join us.
Yeah, fortunately,
on the
driver who's willing to go 70 on Lexington Avenue. So.
Sign me up to that guy. Let's talk about the economic recovery and how it is affecting earnings. Thus far, this earnings season, we've seen some extraordinary surprises, at least surprises as far as the consensus is concerned. But I know, because you and I talked about this before earnings season, you're not surprised at all.
No, I think in this cycle, the outstanding feature, in every economic cycle, you have one sector that benefits disproportionately from the easy monetary policy that usually provokes the cycle. In this one, I believe it's the U.S. corporate sector. In the same way that it was in the mid-90s, it was technology. In the early part of this century, it was housing. Each time you get one of these cycles of easing, there's a sector that really is in good shape during the prior recession and then gets hyperstimulated. And this time,
is that lenders, Michael?
Yeah, for the most part, I think it's operating companies, manufacturing, transportation, the traditional U.S. cyclical businesses, which I think are producing earnings that are far beyond people's model expectations, because in the model, they have a hard time sort of parsing out the extreme strength that you get in a cycle when the balance sheet is this good and interest rates are this low.
Mike, just how badly is the sell side selling the U.S. economy short? The median expectation for S&P 500 earnings is just short of $77. Barton Biggs just there was telling us that he thinks it's going to be $80 to $90 this year and 100 plus next year. What do you think?
Yeah, I think Barton's got it about right. And that's the reason that the stock market's done what it's done over the last 14 months. I mean, this hasn't just been whimsical. There is something behind this. And I think, you know, people after 2008, people were emotionally inclined to invent reasons not to get involved with risk. It was a traumatic experience.
Now, we know you're bullish, Mike, but you're a little less bullish than you were about 6 weeks ago. Why is that?
Yeah, I think since the beginning of the year, we're starting to see global liquidity conditions recede from a high point. And you're seeing central banks in places with strong economies, like in China, like in Brazil, like in Australia, like in Canada, beginning to tighten. So globally, the liquidity cycle that kicked this off is starting
China
to
tighten for the first or the third time, rather, this year, at least as far as the reserve requirements go.
Yes. So a year ago, we were kind of unequivocally in an easing cycle, and it was everywhere. And the buildup in liquidity was dramatic. And you know, you've reached a peak in that, and it's starting to come off, which means that the opportunities begin to narrow somewhat. They don't disappear, but they narrow. There's not quite enough feed for every chicken in the coop at this point.
How about on a valuations basis, notwithstanding last week's drop, the biggest since January in the S&P 500? Stocks are still up since when we talked before earnings season began.
Yeah, I think it continues to surprise people. And in the end, earnings do drive the equity markets, even though you have all these exogenous factors that people love to worry about. And you can excite people by talking about the downside of things like Greece and the problems with the U.S. states and the potential bankruptcy of Harrisburg and all of these things.
Those aren't minor details, so we want to come back to that in a minute. But as far as where you still like the space, I mean, is it still the old industrials, the railroads, and these companies that you've been watching all year?
Yeah, we're still in very, very inward-looking, domestic, cyclical types of businesses, and we're moving a little bit more toward the later cycle types of companies.
Mike, let's talk about some of those exogenous forces, looking overseas to Greece, Spain, Portugal, what's happening in the euro. You like to focus, I know you've been focusing on companies that generate most of their revenue and earnings here in the United States. How might some of the multinational American companies be affected by the sovereign debt crisis?
I think to some extent you get an effect here, but not dramatic. No, I don't think there are a lot of U.S. companies relying on Greece as a source of growth.
Poison. Well, they're not looking to Greece, but the Eurozone being damaged has some pretty serious implications.
Yeah, as the euro weakens, it's going to limit their U.S. dollar revenue in Europe.
It's already had an effect on some of the multinationals, and that's why you've seen some of the big defensive names, many of which are multinational, have really lagged this move. Some of the consumer staples and things that are tied much more towards stable growth rather than economic cyclicality.
You don't find it destabilizing even from a market psychology point of view?
Well, psychologically it is, but practically it shouldn't be. And these are all transitions that need to be made. And Greece has never become a modern industrialized society. Not in my lifetime, and I'm pretty old.
I'm not so sure about that. Mike, thanks very much for joining us. That is Mike Aronstein of Market Field Asset Management.